Welcome to the monthly 3-Edge View from the Edge for September 2024. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3-Edge Asset Management. And as we do each month, Eric and I will provide our firm's most recent outlook for the global capital markets, which is based on our proprietary 3-Edge capital markets model. So as we approach the midpoint of September, a month that has historically been quite challenging for equity markets in the past, the volatility which markets experienced in August seems to be continuing here. So with that in mind, I'd like to bring Eric into the conversation right away. And Eric, before you dig into the 3-Edge asset class matrix and we go over each asset class, it certainly seems that investors are uneasy, certainly about the election and just what's going to happen from here. So maybe you could just give us a, level set, if you will, and give us an update of where you see the state of the world here in mid-September.
I think it seems currently as though everyone's waiting for the upcoming meeting of the Federal Reserve, right? The FOMC, or the Federal Open Market Committee's next week meeting on Tuesday, their announcement made on Wednesday. It seems the market is expecting at least one 25 basis point cut, or 0.25%, and possibly two cuts for a total of 0.5% reduction. And either way, the market is expecting four total cuts, or a full percent, by the end of 2024, and an additional six cuts throughout 2025. So that all said, the market's track record, though, for correctly anticipating the Fed's next moves leaves much to be desired. In any event, the market's reaction and consequently our model's outlook will hinge on the messaging that Fed Chair Powell provides alongside these cuts. If the messaging is received by the market that the economy is softening and the cut or the cuts that they do are to stem the slowdown, that will likely carry a negative message where the July high of this year may be the high, that might be in, and we maybe sawtooth our way down to new lows. If, on the other hand, the message of a mission accomplished by the Fed and the team for taming inflation while sticking the landing, this would likely have a very different market response in which perhaps we retest and or exceed those previous July highs. So we'll no doubt be watching all of this very closely to see how things adapt in our model, as we currently find ourselves on a number of highly nonlinear inflection points with certain factors in the research, and it wouldn't take much to materially shift the outlook in either direction.
Excellent. All right. Thanks for the overview. And now let's dig in. Let's look at the 3-Edge asset class matrix and see what may have changed over the course of last month.
Well, the model research continues to suggest a less favorable environment for equities, which it's been saying for some time. The asset class projections, as I mentioned, have been particularly sensitive to small changes in the economic and market input data. So we'll be watching things closely, but we also don't want to overreact in the short term until the stability of these model projections increases. So we're really only seeing the U.S. and India equities in that positive camp, with Europe, developed Asia, and China/emerging market equities all maintaining that negative outlook. Rates do move down to that mixed outlook, and both gold and commodities remain in that +1 spot alongside the U.S. and Indian equities. So not a lot of movement overall, and yet small shifts may have an abrupt change here.
All right, excellent. All right, so now let's go and dig in greater detail. Let's look at the equity markets, beginning with U.S. equities.
Yeah, August was a volatile month for U.S. equities. The S&P 500, as a measure for U.S. equities, declined by around 6% early in the month, only to claw its way back and end the month up just under 2.5%. And while still highly overvalued by our measure, which we've said for quite some time, the economic factors continue to indicate a somewhat positive outlook for U.S. equities, at least here in the near term. Specifically, we're seeing the decline in long yields that continues to be supportive of gains in U.S. equities. The anticipation of Fed rate cuts we've discussed have already shown up at the shorter end, with the yield on the short-term U.S. T-bill now below 5%, which is also a positive indicator for U.S. equities. I guess the counterpoint, as we discussed, the messaging for the rate cuts by the Fed may be more important than the actual cut itself. And so investors will no doubt be attempting to discern if the messaging focuses more on that returning to normal narrative versus a deterioration in economic outlook narrative, which may ultimately determine whether we continue on to the new market highs or if the top was already in back in July, like we said. So we maintain that positive outlook for now, but on watch.
Okay, excellent. Great. So let's shift now outside the U.S., beginning with European equities, where, as we know, the ECB cut short-term interest rates again this past week. So what is the model saying in terms of European equities?
Yeah, like U.S. equities, European equities suffered that early August drawdown, but ended up with a nearly 5% gain for the month. Presumably the continued prospect of aggressive European Central Bank or ECB rate cuts has market participants, excited about a turnaround in this, lackluster growth region. Our research suggests the potential for continued breakout performance to the upside. There's that potential, but as mentioned, we kind of lack that high conviction currently. So waiting for that to really manifest itself in. So for the time being, the outlook's going to remain negative.
Okay, let's shift to Asia and look at Japanese equity markets. What are we seeing there?
Yeah, I think investors, remain very concerned about the prospects of continued rate hikes by the BOJ or the Bank of Japan. This could lead to a further unwind of the yen carry trade, which may have the effect of further Japanese equity market underperformance. Right. In August, we saw Japanese equities sell off by over 10% early in the month before finishing the month just up over 1%. That's some real volatility. As we know, Japan is heavily dominated by exporter-focused companies, which may be pressured by a short-term headwind of a stronger yen until that Bank of Japan really, indicates they're completing that interest rate hiking cycle. So, in the near term, outlook remains negative.
All right. How about the world of the emerging markets and China in particular? What is the research telling us there?
Yeah, I mean, Chinese equities had much more muted performance, interestingly, in August, with a much lower downside and finishing much more neutral for the month, compared to the other major equity markets we research. But the outlook does remain negative. It is undervalued by our measure, actually much more so than any other market we model. But the combined impacts from sluggish growth due to lack of demand by the domestic base there, a stagnant property sector that doesn't seem to be improving, excessive debt levels which aren't changing, that's keeping this overall outlook negative for the time being.
Excellent. Interesting news note, because gold is such a topic these days, is that Chinese individuals or the civilians in China have been buying gold because they've lost so much confidence in the property market and other areas. So anyway, it's kind of interesting. Let's look at India then, which really, I mean, India has kept pace with the S&P pretty much so far this year. So what does the model see there?
Yeah, India barely earned a gain in August after declining over 4% early in the month. The long-term growth outlook does remain positive. The nearer-term outlook is close to downgrading to a more mixed outlook. So, certain widening credit spread measures that we look at, in addition to a pause in the equity market momentum itself that it's enjoyed for most of this year, has generated some initial concern in the shorter term. So the data coming through this month and in the days and weeks ahead will hopefully give us a more definitive outlook if it's going to continue to carry that positive spot or perhaps move down.
All right, excellent. So now we'll shift out of the equity markets and into the bond market and talk about both rates, U.S. Treasury market, and corporate bonds, beginning with U.S. Treasuries, which have done pretty darn well the first couple of weeks here of September.
Yeah. So Treasury bonds have kind of struggled throughout the year, 2024, but August provided, enough of a return to push, an index of 10-year U.S. Treasuries into positive territory year to date. The 10-year yield declined from 4% to about 3.9%, and now we're roughly in line with where yields actually started the year. The decline in yield could be indicative of a drop in inflation expectations by market participants or a decline in growth that is nominal GDP. Either way, the continued declines would be helpful for bond investors, though it is not clear how much more of a decline we should expect to see here in the near term. And with the potential for rate cuts by the Fed, the dollar may decline in value as well, which could put upward pressure on yields. So, taken together for the time being, we just continue to find those shorter maturities that continue to provide more attractive yield, a better risk-adjusted position on the yield curve. This will no doubt be changing, though, as the Fed embarks on this interest rate cutting cycle.
Absolutely, makes sense. All right, and what about the corporate bond market, which we refer to as the credit markets? What are we seeing there?
Yeah, not too much new here. The inversion of that U.S. yield curve that's been there for some time as we measure it There's that risk of that economic slowdown, and we don't really feel like that's currently reflected in the current corporate credit spreads, which do still remain historically tight. We have seen some widening in investment grade credit spreads recently, but high yield spreads do continue to tighten. So as a result, our outlook remains cautious.
All right, excellent. So, as we know, 3Edge, we're multi-asset investors, and we look at beyond just stocks and bonds. So let's take a look now at the asset classes they refer to, or we refer to as hard assets. That includes gold and commodities, and maybe beginning with gold, which has been really a hot topic, throughout 2024. So what's the model telling us at this point looking forward?
Yeah, gold has been one of the best performing asset classes year to date, up over 20% through the end of August. And while the outlook does remain favorable due to continued geopolitical conflicts on multiple fronts, a potentially weakening dollar, and excessive federal debt levels, there is shorter-term concern of profit taking, given the recent strong rally to these new all-time high levels that we're at. So, all said, the prospect of continued declines in real, that is inflation-adjusted U.S. interest rates, could be supportive for continued gains in the price of gold. We maintain that positive outlook.
All right, excellent. And then let's look at the other one other piece of the hard asset world, which is commodity prices. I've seen, oil had sort of steadily declined through the summer, and it looks like it's maybe starting to tick back up a bit the last week. But what's the model telling us about commodities writ large at this point?
Yeah, based on our model research, the general outlook for commodities is somewhat favorable, with shorter term concern, like we've been kind of, saying with many of these asset classes. You're seeing slowing demand from China, but that may be offset by the continuing global geopolitical conflicts, right? Along with that potential for the weakening dollar we keep discussing due to that looser monetary policy that's expected through year end. So, a pause in the rising price of gold could also be a headwind for commodity prices. So it's generally still positive, but kind of on notice to potentially move down to that mixed camp, like several of the asset classes. We just find ourselves kind of right at a rough edge here.
Okay, excellent. Thank you. Thanks for your update on our outlook. And so now we, along with everybody else, will wait to see what the Fed will do next week in terms of lowering interest rates. And as you mentioned, it'll be very interesting to see how the market reacts to not only what they do, but what they say. So a lot to happen in the course of the next week. So that will do it for Eric and me for this month's 3Edge View from the Edge. Eric and I will be back in early October, another edition of the monthly View from the Edge. If you'd like a hard copy of the full View from the Edge newsletter, that's always available on our website, and that's 3edgeam.com. Steve Cucchiaro and I will be back next week with the latest edition of the 3Edge Week in Review. And as a reminder, our entire library of video content is always available on our 3Edge YouTube channel. And if you feel like someone might benefit from those videos, please feel free to share them. And lastly, if you appreciate these weekly videos and would be so kind as to subscribe to our 3Edge YouTube channel, we would be most appreciative. So, on behalf of Eric and everyone here at 3Edge, thanks for listening.